2022 is probably going to get harder. If you look at the long-term debt cycle, which is essentially the issue when you run into debts that are so high, they're essentially unpayable, and that they end up having to, in some way, reset the monetary system in order to pay it. The bond market's already basically telling the Fed that they're not going to be able to raise rates as much as they think, the long end of the curve. Now, I don't trust the bond market in a lot of things in this kind of post global financial crisis regime. When central banks are the biggest buyers of treasuries, the whole signal for what treasuries can tell us is distorted. So, for example, a 5-year treasury that you bought in 2020 was super low yielding, and it already got outpaced by inflation within a year, like all 5 years of coupons. The same thing for 10-year treasury. If you bought a 10-year treasury in mid 2020, you're already, like, inflation could be zero for the next like 8.5 years, and the first year and a half already erased all of your coupons. And so I don't really view the bond market as a useful tool for telling us what inflation is going to be, but it can be a useful tool for kind of sensing the rate of change of the economy. So you get these it goes up and down, I think, at appropriate times, more or less. It's still kind of that sensor. And so the bond market's kind of, flattening and saying that they are doubting that the Fed's going to be able to raise rates as much as they said. And generally the long-term track record is that every cycle they get to a lower high in terms of what they're able to raise rates to. So my base case would be to see that happen again. There's so much debt, and the fiscal deficits, even without stimulus, active stimulus, are still large. And so it really comes down to whether or not the foreign sector is willing to buy treasuries. They've really slowed down their purchases starting around 2013, 2014. Especially China, but also other countries as well. And so to the extent that the foreign sector is not necessarily willing to finance a lot of this, and if we look at, so they just, they're in the process of raising the debt ceiling. The Fed's, the Treasury's account at the Fed, which is basically their cash buffer, is super low. So they want to increase their cash buffer while also issuing bonds for ongoing government purposes. So they actually want to issue like $1.5 trillion worth of treasuries in the next 2 quarters. And so the longer that goes, if the Fed were to try to, not only stop buying treasuries, but actually start reducing their balance sheet, that starts squeezing things. Basically, the banks have to buy more treasuries, and the foreign sector has to buy more treasuries. And so you could get like illiquidity problems in the treasury market. You also can crowd out other types of investments. And so that's when you can see kind of a correction in the stock market. Well, the U.S. is very reliant on foreign manufacturing of goods. And so we've been running a structural trade deficit, really going back all the way to the founding of the petrodollar system in the 70s, but especially since the second half of the 90s with NAFTA and then China entering the World Trade Organization. We have a structural trade deficit, and so we're very, very reliant on foreign companies selling us our goods. And then also, if you look at the S&P 500, a very large percentage of their revenue is international. Now, it's been kind of flat to down over the past decade. We kind of hit a peak level for how much revenue is coming from abroad in the S&P 500. It's partly because the foreign sector has been rather slow, right? It's not been a lot of growth there, and so they can only account for so much. But if you were to just subtract the rest of the world from the equation, you're taking out like half of S&P 500 revenue, right? So that's irrecoverable. And so it's clearly a global system. In addition, the United States is reliant on foreign capital flows. So because we've outsourced our industrial base so much, we're very, very reliant on financialization. We're very reliant on our asset prices going up, more so than most other countries. So if you have an extreme stagflation scenario, it means you actually have a recession with high inflation. You can also get stagflation in rate of change terms, where you just have basically the economy growth is slowing. It's still positive, but it's growing at a slower pace while inflation's ramping up. And that's essentially what we saw in Q3. You had kind of that mild stagflationary scenario. Q4 and into 2021, you've seen a little bit of a growth deceleration for a period of time. There's all sorts of, again, going back to the foreign sector, you have different countries locking down at different times. You have different virus variants, whatever the case may be. You have these different kind of ebbs and flows. And so we've had somewhat of a receleration. So I wouldn't describe that fourth quarter was stagflationary. I think as you look into 2022, if they continue on their tightening path and there's less accommodation, I think inflation is still going to be pretty hot for a while. And so you can get that stagflation, at least in rate of change terms. You might not have an actual recession, but I think it could be less, pleasant than it was for many people in 2020, 21, where you were just getting money and you could go like speculate on stocks with it. Depending on where you were in kind of the economy, it was pretty easy for a lot of people. Where I think 2022 is probably going to get harder. If you look at the long-term debt cycle, which is essentially the issue when you run into debts that are so high, they're essentially unpayable, and that they end up having to in some way reset the monetary system in order to pay it, whether it's financial repression holding rates below the inflation rate for a long period of time, whether it's something like a gold devaluation, those types of events. So my overall base case is I still think it grinds higher over the longer term. It could be challenging to do in a tightening environment, but if stocks start doing poorly, then gold looks attractive in relative terms. Also, in an inflationary environment, stocks can face margin pressures. So if their expenses rise faster than their ability to raise prices for their business, they could run into margin pressures. We've actually seen evidence that margins may have peaked in the recent quarter, and that they're kind of now on a sideways to downtrend. In addition, if you look at certain types of equities, you have maybe antitrust regulation issues that they could face. You have other sorts of things that can go after them. So they have a variety of risks, whereas a monetary metal that doesn't have a profit margin and it, just enjoys negative real rates and expansion of the money supply, while it itself is, very slow inflation just from mining activities. It's measurable, it's low. That's a more attractive in that type of environment. And so overall, I think it's still an interesting asset to hold as part of a diversified portfolio, especially for people that don't have a super high conviction on any one stock sector, or super high conviction on Bitcoin. People have different kind of probability assessments for how they see things working out. Gold and silver generally were in like a band of, say, gold was 10 to 20 times more valuable than silver on multiple continents for long periods of time. In modern history, it was often close to the middle of that, around the 15 to 16 range. And one of the arguments I've seen that I think is compelling is essentially when you had modern banking. So you had paper currency tied to gold, and then you also had telecommunications channels, so you could send money around the world between banks. Starting 150 years ago, right, with the invention of the telephone and those types of technologies, you essentially improved gold. The one downside gold always had relative to silver was that even though it was a harder metal, it was less divisible, right? Because even a small gold coin was a lot of money, whereas silver was more of the every person's money. And so that's why you had a lot of bimetallic standards throughout history, even though they have their own challenges.